Okay, here it goes. Everyone who's joined, thanks for joining us. We're just live streaming right now this to Facebook, and we'll start in 1 minute. Again, for those joining, thanks for joining us. We'll be starting in 1 minute. We're just setting up the live stream on Facebook, and we'll get all your questions answered. Okay, while that process gets set up, I guess it could just kickstart this. Oh, there we go. We're live on Facebook. Okay, so everybody who's joined us so far, thank you so much for joining. You'll notice that in the chat window, I included a link there to the slides that Mark will be using in today's webinar. For those of you who are repeat attendees, you already know how this works. For those of you who are new, welcome. Mark here is the expert when it comes to student loans. He's been quoted in a lot of top newspaper, magazines, digital media companies. We're talking Forbes, we're talking Wall Street Journal. He's testified in front of Congress about the subject. So if you have questions relating to student loans, how to repay them, and all of that process, Mark is the expert to go to. So he'll start with a presentation. If you guys have questions, please do feel free to ask them, either through the chat window, preferably through the Q&A window. That way that everybody can see the answers and whatnot. Again, the slides are attached to, there's a link to them on the chat window, and this presentation is being recorded. It's also being live streamed on Facebook. So if you guys want to share it with your friends and family, feel free to do so. So without further ado, I'll let Mark get started.
And thank you, Julian. So this is the second of 5 webinars about student loans. This one is about repaying student loans. The previous one was about borrowing student loans. And the next few webinars will be about refinancing student loans, loan forgiveness, and choosing a loan. We also have additional webinars under development, including a webinar about dealing with financial difficulty and a webinar about how much to borrow. We have developed a lot of student loan content on savingforcollege.com. We now have more than 500 articles about student loans on the site, trying to give you information, advice, and tools for making a smarter borrowing decision. So let's talk about repayment. When does repayment begin? Well, there are differences between federal loans and private loans. Federal loans typically will start repaying about 6 months after the loan, the student graduates or drops below half-time enrollment. There was a previous federal loan called the Federal Perkins Loan, which ended in 2017-18, which offers a 9-month grace period. Private student loans, in addition to offering a 6-month grace period after the student graduates, also have several in-school payment options. The first two, full deferment and immediate repayment, are similar to the ones offered by federal student loans. Making payments during the in-school period, whether it's a full payment, an interest-only payment, or what are sometimes called touch payments, or $25 per loan per month, are a way for the lender to keep in contact with the borrower so that the borrower is less likely to forget about their loans. And some lenders will even give incentives for borrowers to sign up for this because it's better for the borrower, it's also better for the lender. And they may give slight interest rate reductions for these in-school payments. It varies by lender, and it can be as much as half a percentage point or full percentage point, depending on the type of in-school payments. And typically, about a third of students will go for each of these in-school payment options, other than the full deferment. Now, there are no payment penalties on federal or private student loans, so nothing stops you from making payments during that in-school period, even if there's not a formal program. I mean, you can make payments of the interest even on a federal loan. You just have to calculate how much that interest is. It's not a standardized program. If you don't pay the interest as it accrues, it will get capitalized, which means it gets added to the loan balance, increasing the size of the loan. And that then leads to compounding of interest, where you pay interest on interest. So let's talk a little bit about the typical debt that people graduate with. So the average debt at graduation for a bachelor's degree is just under $30,000, with about 2/3 of the students graduating with student loan debt. Parent loans, it's also about, oh, well, that number is not correct. It's actually a little bit higher than that, but a much lower percentage. I'm going to have to correct this slide. For a master's degree, you're talking about $45,000 with half of students borrowing. PhD is about a little bit more than double that, with about half of students borrowing. And then for law and medical school, you have a much greater percentage of students borrowing, and they graduate with six-figure student loan debt. So there is a payment application order when you make payments, and this is important for understanding the how student loan payments work, how an extra payment will affect your loan balance. So typically, for most federal and private student loans, the payments are applied first to the late fees and collection charges, and then to interest, and only after the accrued, the interest that is accrued since the last payment has received a payment, the remainder is applied to the principal balance. So if you pay more, given that the first and second options usually will have been taken care of, that extra payment is going to pay down the principal quicker. There are certain repayment plans, like income-driven repayment, have a different order. Instead of having late fees and collection charges first and interest second, they swap the order. So payments are applied to interest first, and then to late fees and collection charges, and last to the principal balance. So it's worth emphasizing that any additional payment beyond the interest that has accrued, and that could include interest that accrued during a deferment or forbearance, is applied to the principal balance of the loan. There are, however, two different ways of making extra payments on a loan. They are the Avalanche method and the Snowball method. So making extra payments is going to save you money by paying off your debt sooner and reducing the total interest that you paid, because there's less time for that interest to accumulate. Both the Avalanche and Snowball methods apply extra payments to your loans. They differ, however, in which loans are chosen to receive the extra payments. The Avalanche method applies the extra payments to the loan with the highest interest rate, whereas the Snowball method applies the extra payment to the loan with the lowest loan balance. So proponents of the Snowball method says that it gives you a psychological boost by giving you quick wins and paying off some of your loans sooner. But that may work with credit cards. It doesn't really work all that well with student loans because the loan balances are bigger. And so even the loan with the lowest loan balance may take you a year or two before it's paid off in full. So you're not really getting an immediate psychological boost. It's better to apply the extra payment to the loan with the highest interest rate, because that's going to save you the most money over the life of the loan. Now let's talk about deferments and forbearances. Deferments and forbearances both suspend the repayment obligation. But the difference between them is that a deferment has the federal government paying the interest on subsidized loans. You remain responsible for the interest on unsubsidized loans, but you get this benefit on subsidized loans where the government's going to pay the interest during a deferment. And that includes not just the in-school deferment and the 6 months grace period, but if you go back to college, that in-school deferment is also has the federal government paying the interest. And there are also an economic hardship deferment and an unemployment deferment. This is in contrast with a forbearance where the government doesn't pay the interest on any of the loans. So regardless whether it's a subsidized loan or an unsubsidized loan, the borrower remains responsible for the interest. And if that interest is not paid as it accrues, the loan balance will increase by the amount of that interest that is capitalized. Okay. And typically on federal loans, the interest will be capitalized at the end of the deferment or forbearance period. Private student loans, some of them will do it at the end of the deferment or forbearance period. Some of them will do it more frequently as monthly. And the difference between once at the end of at a loan status change versus doing it monthly is that there's more compounding going on. So it yields a slightly higher loan balance at the end of that deferment or forbearance period. Now, private loans will use the terms deferment and forbearance as though they are synonyms, because they figure that students are familiar with them from their federal loans. But the difference is on a private student loan, there is no subsidized interest. So they are functionally the same. They're really just forbearances where the interest continues to accrue. Your obligation to make a payment is suspended, but your loan balance will get larger if you don't pay that interest as it accrues. Now, in addition to traditional forbearances, private loans also tend to offer a partial forbearance in addition to a full forbearance. Recognizing that that interest is going to dig you into a deeper hole, they offer you the option of making interest-only payments. So payments to principal get suspended, you pay the interest instead. That's a much lower payment and it may be more affordable without having the drawback of your loan balance getting larger and larger. Now, the federal student loans have several repayment plans. There are a dozen student loan repayment plans for federal student loans. It's far too complicated. But most of them are variations on three main types of repayment: level repayment, graduated repayment, and income-driven repayment. The difference between standard repayment and extended repayment is both of them are level payment plans where your monthly payment is the same each month throughout the entire term of the loan. But with standard repayment, it's a 10-year repayment term, whereas extended repayment generally has a larger repayment term. Now, there are actually two different types of extended repayment. One is a 25-year repayment term if you have more than $30,000 or more in total student loan debt. You don't have to consolidate your loans to get that repayment plan. The other requires you to consolidate your loans into a single repayment plan, and it will provide you with 12, 15, 20, 25, or 30-year repayment terms, depending on the amount of debt. For example, if you have $20,000 to $40,000 of federal student loan debt, you're going to get a 20-year repayment term. If you have 40 to 60, it's going to be a 25-year repayment term. And if you have more than $60,000 in federal student loan debt, you're going to get a 30-year repayment term. Now, graduated repayment starts off with low monthly payments that are barely above interest only, and they increase these payments every 2 years. Graduated repayment is subject to what's called the 3 times rule, which requires none of the payments that you make to be more than 3 times any other payment. So given that you're starting off with lower monthly payments, you will end up with final monthly payments that are no more than 3 times the original loan payments. So it is possible, depending on certain odd factors, for the monthly payments to start off a little bit higher and then go down over time. But in most cases, it starts off low and increases every 2 years. And just like the level repayment plans, graduated repayment has 2 versions, one involving just a 10 or 25-year repayment term. The other, requiring consolidation, gives you 10, 12, 15, 20, 25, or 30-year repayment term. Now, there are 4 income-driven repayment plans. Members of Congress seem to love these repayment plans, and they always want to create a new one to put their own stamp on it. And these repayment plans differ based on the percentage of discretionary income, the definition of discretionary income, and the repayment term. I will give some more details in the next slide. In addition, the income-driven repayment plans work well with public service loan forgiveness, which will cut the repayment term to 10 years from 20 or 25 years and forgives the remaining debt for borrowers who work full-time in a qualifying public service job. Medical school graduates often will use the pay-as-you-earn repayment or income-based repayment plan during their internship or residency because they have the lowest monthly payment, and they will be earning potentially some loan forgiveness. When they get their full-time job as a doctor, their salary increases and they will no longer qualify for reduced monthly payment. So they'll be in a standard 10-year repayment term, which will preserve the forgiveness that they already earned. There's also a 5th income-driven repayment plan called income-sensitive repayment, which is available only in the FFEL program. And it's 4 to 25% of income, usually for a year in duration, and must be at least the new interest that accrues. This is kind of like a partial forbearance in the private loans. Then there's these things called alternative repayment for borrowers for whom none of the existing repayment plans for which they're eligible addresses their situation. But in practice, they are similar to extended repayment, graduated repayment, and income-driven repayment. For example, parent borrowers who are not eligible directly for an income-driven repayment plan might use alternative repayment to get something that looks like income-driven repayment. So now let's talk about the differences between the income-driven repayment plans. And I've listed here not just the 4 existing income-driven repayment plans: income contingent repayment, income-based repayment, pay-as-you-earn repayment, and revised pay-as-you-earn repayment, which are known by their acronyms, ICR, IBR, Pay, and Repay, but also the income-driven repayment plans that have been proposed by the 2 leading candidates for president in the upcoming elections. As I said, politicians seem to love creating brand new income-driven repayment plans, even though the existing ones are perfectly adequate as a safety net for borrowers whose income is out of sync with their income. So these income-driven repayment plans, you can see the percentage of discretionary income is different. ICR, which was the first one, started off at 20%, and then the next ones reduced to 15% and 10%. The definition of discretionary income also changed. Originally it was subtracting 100% of the poverty line from your income. Now it's subtracting 150% of the poverty line from your income. Vice President Biden has proposed subtracting a fixed number, $25,000, which is slightly above 150% of the poverty line for a family of 1 from your income. It's a simplification. It leads to slightly different characteristics of the loan payments. Another major difference is the time until forgiveness occurs. Now, this is forgiveness at the end of an income-driven repayment plan. It's not tax-free under current law. That forgiveness, the amount that's forgiven, will be treated as income, which can lead to a tax bill. That tax bill will be lower than the amount of debt at that time, but still it is something that you need to be concerned about. Whereas public service loan forgiveness is tax-free and it's after only 10 years. So the ICR and IBR are both at 25 years. Pay is at 20 years. Now, the revised pay-as-you-earn repayment plan is 20 or 25 years, depending on whether or not you have graduate student debt from graduate school. If you have no debt from graduate school, you're at 20 years. If you have some debt from graduate school, it's 25 years. Now, President Trump's income proposal is to slightly increase the percentage of discretionary income, but then to reduce the loan term for undergraduate students and increase it for students who have graduate student debt. And so it becomes 15 years if you're only undergraduate debt, 30 years otherwise. And so that, and especially for like a medical school student, they've been characterizing that as indentured servitude, because you're in medical school for 4 years and you have a internship and residency for 4 years, maybe a fellowship for an additional year. So it may take as much as 10 years before you're working. This is after undergraduate school. And so 30 years means you're going to be repaying those student loans until you retire. Both the Repay program and President Trump's proposal have marriage penalties. If you're married, they base your monthly payment on your joint income, even if you file separate returns. Whereas the income contingent repayment, income-based repayment, and pay-as-you-earn repayment will base it on just the borrower's income if they filed federal income tax returns as married filing separately. Vice President Biden's proposal cuts the monthly payment in half and sets the repayment term at 20 years with loan forgiveness, tax-free loan forgiveness after 20 years. You'll also notice the rightmost column might show a payment cap. This specifies whether the monthly payment is capped at the standard 10-year repayment amount. With ICR, Repay, and President Trump's proposal, your monthly payment will increase as your income increases without any cap. And that's done as a way of saving money on the repayment plan. But it also means that, I mean, if it's better for the federal government, it means it's more expensive for the borrowers. So just to compare with that $25,000 figure that Vice President Biden has proposed, 150% of the poverty line is $19,000, a little bit more for a family size of one, $25,860 for a family of two, $39,000 for a family of four, and this is based on the 2020 poverty lines. So it's going to be less discretionary income for someone who is a single. It's going to be roughly the same for a family size of two, but it's going to be much lower income for a family size of four. Now let's compare the level repayment plans. So I'm comparing 10-year term and with a 20-year term. And these examples assume $20,000 in debt at 6.8% interest. And what you can see is that increasing the repayment term from 10 years to 20 years is going to reduce the monthly payments by about a third, but it increases the total payments by about a third and more than doubles the total interest paid. So it significantly increases the cost of the loan. The last row of this table is the net present value, which is a measure of looking at a future stream of payments, how much you would have to invest now to cover them. It's a way of discounting those future payments back to the present. And you can see that when you discount the total payments, the difference becomes a lot less magnified. So instead of total payments being a third higher, they're only about 6.6% higher. But still, and you are going to pay more over the life of a 20-year term than over a 10-year term. Now let's compare several of these repayment plans. So we've got extended repayment with 12 to 30 years, and we're comparing all of these to a standard 10-year repayment plan. And we also have graduated repayment under one scenario and income contingent repayment under various assumptions where your salary is the same as your debt. And you can see that the reduction in the monthly payment increases with the longer repayment term, and graduated repayment is kind of in the middle. Income contingent repayment is actually not all that much different in terms of the average reduction in the monthly payment, but the way it's spread out over time and in alignment to your income is much better than graduated repayment. In a way, graduated repayment was kind of a simplified income-driven repayment plan before we had income-driven repayment plans. And once Congress decided to allow the payments to be pegged to your income, then graduated repayment became a lot less necessary. But you can see here that as the monthly payment gets smaller, the total interest paid increases pretty sharply. As we noted before, increasing from 10 years to 20 years cuts your monthly payment by about a third, but more than doubles the total interest paid. If you go with a 30-year repayment term, it's a 43% reduction in monthly payment, but you're increasing the total interest by 250%. And that's more than tripling. That's multiplying by 3.5 the total interest paid. So you pay for choosing a lower monthly payment. It increases the total interest that you pay over the life of the loan. If you want to save the most money, you need to choose a shorter repayment term. So I suggest choosing the repayment plan with the highest monthly payment you can afford. Let's talk about consolidating and refinancing student loans. And there are several advantages and disadvantages of consolidating or refinancing your student loans. Consolidation is a term that's usually used with federal student loans. It's not a true refinance. The interest rates are more or less preserved. It's a weighted average of those interest rates on the loans that are being consolidated. Whereas with private student loans, the term refinance yields a new interest rate based on your current credit score. And if you refinance with a cosigner, that cosigner's credit score, usually the higher of the two credit scores. Now, if your credit scores are lower, you're going to get a higher interest rate. If your credit scores are higher, then you'll get a lower interest rate, and you'll also be more likely to be approved. So both of these are a way of taking the multitude of loans that you received and merging them into a single loan. Since the federal loans don't change the interest rate, it's a weighted average, it's preserving the cost of the loan. If you want to try to get a lower interest rate, maybe you have federal loans from several years ago when interest rates were higher, then you would need to refinance them into private student loans. But that comes with a lot of drawbacks. And the federal loans have superior benefits, not just lower interest rates in general, but also the current payment pause and interest waiver through September 30th, deferments and forbearances for 3 years instead of 1 year, income-driven repayment plans, and loan forgiveness options. So you need to think twice before you do that, though many lenders will now allow you to refinance federal loans into private student loans. Okay. Another thing to watch out for is that if you're consolidating a federal loan, say you have FFELP loans and you're consolidating them into the direct loan program, or you already have loans in the direct loan program, but you want to switch your loan servicer. When you consolidate that loan, it's going to reset the qualified payment clock on loan forgiveness. It also resets the clock on deferments and forbearances. So there are pros and cons. Because public service loan forgiveness is based on the loan, not the borrower, when you get a new loan, it starts over from zero. So if you're pursuing public service loan forgiveness and your loans are already in that public service loan forgiveness plan, you probably shouldn't consolidate. On the other hand, if you've been using deferments and forbearances and you reach the 3-year limit on them, well, if you consolidate the loans, that consolidation loan is a new loan, which has a new 3-year deferment and a new 3-year forbearance. So, and that can extend the amount of time before you have to repay your loans, though interest may continue to accrue, causing your loan balance to get bigger and bigger and bigger. When you hear about borrowers who complain about their loans having doubled or tripled in size, that's usually because of an extended period of non-payment. Now, when you're choosing to consolidate your loans, that can interfere with your ability to accelerate repayment of the loans, because then all your loans become a single loan and you can't target the loan with the highest interest rate for quicker repayment. So there are some workarounds. One would be to not consolidate that highest rate loan, to keep it out of the consolidation so that you can pay it down, make extra payments on it, and thereby reduce your average payment. But you should also compare the weighted average of the interest rates on the other loans with the interest rate on that consolidation loan or refinance. If the weighted average is lower than that new interest rate that you're going to get, you shouldn't consolidate at all, because that's going to increase your costs as opposed to decreasing it. It means that the only savings is coming from having that highest rate loan in that consolidation. So you just keep them separate and you make extra payments on that highest rate loan, you're going to save money that way. Now, we mentioned public service loan forgiveness. It's an option for federal student loans where if you work full-time in a public service job, after 120 payments, which is 10 years worth of payments, the remaining balance will be forgiven. Now, there are the repayment plans that are eligible for this include not just income-driven repayment plans, but standard 10-year repayment. Now, if you were in standard repayment for 10 years, you'd have nothing left to forgive. So the purpose of standard repayment is to preserve the loan forgiveness that you earn during periods when your income is lower. Okay. And as I said before, loan forgiveness under public service loan forgiveness is per loan, not per borrower. So you might have different loans earning forgiveness at different periods of time, depending on which loans entered repayment at which time. And you might have had some loans from graduate school that entered repayment later than your loans from undergraduate school. Now, in addition to the standard 10-year repayment and the income-driven repayment, there is also a temporary option for loans that were in extended or graduated repayment. It's called temporary expanded public service loan forgiveness. And Congress has allocated a pool of money to forgive these loans. The requirement is, let's say that you were accidentally or you didn't realize that you were in an extended or graduated repayment plan, you can still qualify for public service loan forgiveness if your last year of payments are at least as much as the payments would have been under an income-driven repayment plan. Worst case scenario, you switch your loans into income-driven repayment for the last year. Now, you've probably heard that a lot of borrowers complaining about how their loans, they've been rejected for public service loan forgiveness. It's not just because they were in the wrong repayment plan. In many cases, the borrowers haven't been in repayment for 10 years. There's no way you can make 120 qualifying payments in less than 10 years. And surprisingly, a lot of the borrowers who have applied and been rejected have been rejected for that reason. But there are also problems with the loan servicer not being able to count the number of qualifying payments correctly either, where, and I've seen borrowers who the loan servicer said that they had made 65 qualifying payments when in fact they had made 125 qualifying payments, and they had to appeal and get it reviewed, and then the loan servicer said, yes, you're right, you do have 120 qualifying payments. They forgive the debt, and then the extra payments get refunded to the borrower. Another example of people being rejected is if you qualifying public service jobs include working for the government. Well, if you're working for a government contractor and not directly for the federal government or a state government, that doesn't count. It's only if you work directly for a government that is considered qualifying employment. In addition, borrowers may have loans in the FFEL program, the Federal Family Education Loan Program, and not the direct loan program. Only direct loans are eligible for public service loan forgiveness. However, a borrower of a FFELP loan could consolidate their loans into a federal direct consolidation loan to qualify. That would convert them into direct loans. Private non-federal loans can't be made eligible for public service loan forgiveness. Now, remember, when you consolidate your loans, you're resetting the clock on loan forgiveness, but the payments that you made in the FFEL program don't count anyway. So if you're pursuing public service loan forgiveness and you didn't realize that your loans were in a non-qualifying program, well, you could consolidate and you start over at 10 years, but after 10 years, the remaining debt will be forgiven. Now, a question I often get asked is whether parent loans are eligible for public service loan forgiveness. And it turns out that Parent Plus loans are eligible, but it's a little tricky. You have to jump through a few hoops in order to qualify. So clearly, to earn some forgiveness, you need to be in an income-driven repayment plan, but Parent Plus loans aren't directly eligible for an income-driven repayment plan. Yet there is a workaround. And that's if the Parent Plus loan will enter repayment after July 1, 2006, because loans from before then are ineligible, and is included in a federal direct consolidation loan, that consolidation loan is eligible for income contingent repayment. So you could potentially qualify for some forgiveness if the parent is working in a public service job. The parent doesn't earn forgiveness based on their child working in public service. It's only if the parent is working full-time in a public service job. And remember, income contingent repayment has a monthly payment based on 20% of discretionary income. With a higher definition of discretionary income, it's subtracting 100% of the poverty line from adjusted gross income. And it has a 25-year repayment term as opposed to a 20-year repayment term. So it has the highest monthly payments for the longest duration of any of the income-driven repayment plans. But if you're in public service loan forgiveness, instead of 25 years for repayment, you'll be just 10 years in repayment, and that forgiveness will be tax-free. Now, in addition to loan forgiveness, there are a variety of loan cancellation and discharges. Technically, loan forgiveness and loan discharge are both types of loan cancellation, but the terms cancellation and discharge are often used interchangeably. So federal loans have death and disability discharges. One thing to note that a Parent Plus loan can be discharged not just if the parent dies, but if the student on whose behalf the loan was borrowed. If they die, the parent loan will be canceled. And through the end of 2025, death and disability discharges are tax-free. Bankruptcy discharge applies to both federal and private student loans. It's extraordinarily rare. Very hard for a borrower to qualify for bankruptcy discharge. It requires the borrower to demonstrate in an adversarial proceeding, which is like a lawsuit within a lawsuit, that repaying the loans imposes an undue hardship on the borrower and the borrower's dependents. Congress never defined what it meant by undue hardship, so it was left to the courts to define the term. And depending on which circuit you're in, there's a different definition. But generally, it involves showing that you are presently unable to repay the debt and that the circumstances that prevent you from repaying the debt will persist for most of the life of the loans. And you also have to have made a good faith effort to have used all of the options for financial relief that are available to you. And that includes deferments, forbearances, and income-driven repayment plans. Oftentimes, when a borrower of federal loan seeks a bankruptcy discharge, the federal government raises the availability of income-driven repayment as a defense to the discharge. But there still have been some borrowers who have succeeded, especially when their inability to repay the debt is due to not their own disability, but rather their child's disability. If the parent is totally and permanently disabled, the loans can be discharged through a disability discharge, but not if their child has a severe disability, maybe something that requires 24/7 nursing care. Now, there are a variety of other loan discharge options, like a closed school discharge is if you were enrolled, or if the school closed while you were enrolled or within 120 days of your withdrawal, and you are unable to complete your education either through a teach out or at another college. Now, private student loans, more than half of them offer death and disability discharges. Death discharges are more common than disability discharges, but it depends on the lender. Now, and certainly with disability, it's a good idea to check whether or not the lender offers it. With the absence of a death discharge, oftentimes you can appeal to the lender's ombudsman for compassionate review. And sometimes if the circumstances are really dire, they will grant a cancellation of the debt. But it really depends on the individual lender and the nature of the special circumstances. If the borrower was killed in action while serving in the U.S. Armed Forces, they are more likely to cancel that debt even if they don't have a formal death discharge program. Now, if you want to save money on your student loans, there are several things that you can do to cut the cost of repaying the loans. The first thing is you want to make payments of at least the interest on any unsubsidized loans, including private loans, during that in-school period and grace period, because that prevents the capitalization of interest. So your loan balance doesn't grow while you're in school. And keep in mind that a higher loan balance at repayment is not just more money that you have to repay, but it means you're going to be paying more interest over the life of the loan, because capitalization of interest leads to the charging of interest on interest. Auto debits is also known as auto pay, where lenders will give you an incentive to sign up to have your monthly payments automatically transferred from your bank account to the lender. They will also usually require you to receive your bills electronically via email, but you can save 1/4 percentage point, or in some cases 1/2 percentage point, just by signing up for this. You retain control over it, and it's not that the lender's reaching into your bank account to take your money. Rather, you're telling your bank to send them the monthly payment each month. I wish my mortgage had such a discount. Mortgage lenders generally don't offer that. You should choose the shortest repayment term you can afford, because not only does that reduce the amount of time you're in repayment, but it reduces the amount of time during which interest can accumulate, and it saves you on the interest. There is a federal student loan interest deduction that's available on both federal and private student loans. Up to $2,500 in interest on these loans can be deducted from your income, even if you don't itemize. I'll get to more about that in a bit. You could refinance to get a lower interest rate. And the interest rates right now are at or near historic lows. So you might be able to lock in a lower rate, especially if your loans are several years old when interest rates were higher. It is important to distinguish between fixed rate loans and variable rate loans. Fixed rate loans will not change, whereas a variable rate at this point has nowhere to go but up. The only reason why I would suggest ever refinancing into a variable rate these days would be if you know that you're going to be able to pay off that loan in full within a few years before the interest rates rise too much. Then you can play a little game of arbitrage and save money on having a lower interest rate now than the equivalent fixed rate over that entire repayment term. But if you're going to be repaying that loan for the entire repayment term, a fixed rate is going to be better. It's going to yield more predictable monthly payments, and you don't run the risk of your interest rate rising without bound. Um, Now, when you're refinancing federal loans into private loans, usually the federal loans have lower interest rates unless they are loans from several years ago when interest rates were higher. If you're comparing current loans, the only case in which a private loan will have a lower interest rate is for a Federal Direct Plus loan if the borrower has excellent credit. There's a little bit of play in the joints where the fixed rates available on federal loans, which are Federal Parent Plus loans, currently have a 5.3% interest rate for new loans made from July 1st of this year through June 30th of next year. It's very hard for private loans to beat that unless they're secured loans or the borrower has very, very good credit. Now, there's also, not listed on this slide, there's student loan repayment assistance programs, which are offered by employers. About 8% of employers offer these LRAPs, as they're known. They typically pay $100 per month towards your student loans. And these LRAPs, through the end of this year, are tax-free. The CARES Act made them tax-free from March 27th through December 31st. The hope is that the tax-free benefit will be made permanent, but initially Congress just made it for the rest of this year. And so this is a little bit extra money to help you repay your student loans. The employers offer it as a recruiting and retention incentive because it's what their employees care about, especially ones who graduated recently. So now let's talk about the student loan interest deduction. As I mentioned, it's an above the line exclusion from income for up to $2,500 in interest paid on federal and private student loans. An above the line exclusion means that you can claim this even if you don't itemize deductions. And it reduces your adjusted gross income, which may have side effects on your taxes, not just a direct benefit. If you translate that into what the reduction is in your tax liability, it can be up to $6,000, assuming a 24% tax bracket, $600, assuming a 24% tax bracket. On average, though, people save about half and get about $300, half that amount reduction in their tax liability. So you'll save a few $100. Every dollar helps. Now, the income phase outs are that I list here are for 2020. They get adjusted by inflation every few years. So let's give you some additional advice when borrowing and repaying student loans. You want to target the most expensive student loan for quicker repayment, the Avalanche method, as opposed to the Snowball method. And that may not be student loans. That could be your credit cards or other types of debt. So you want to use extra money to pay down your highest interest rate debt, even if it's not a student loan. And you need to compare them on an apples to apples basis. So look at the after-tax interest rate, and if there are fees involved, roll them into the interest rate through APR. Watch out for interest capitalization because it's digging you into a deeper hole from which it's going to be more difficult to escape. Interest continues to accrue during a forbearance. So a forbearance is better than defaulting on your loan, but it's not an ideal option. You shouldn't prefer it over making payments. You should never carry a balance on your credit cards, because if you are carrying a balance, that means that you're spending more than you can afford to repay. You're literally living beyond your means. You should review your credit reports at least once a year at annualcreditreport.com. That's a free service offer that was sponsored by the Federal Trade Commission. There are 3 credit reporting agencies, TransUnion, Equifax, and Experian, that participate. But they may try to sell you other services, such as copies of your credit scores or credit monitoring. You don't need to pay for them. Now, normally it's once a year, once every 12 months that you can use these. But during the pandemic, through April 30th of 2021, you can check your credit reports weekly instead of once a year. You need to open and read your mail from your school and from your lenders. Don't use what's often called the freezer method for dealing with your correspondence. And the freezer method involves you put your mail unopened in a Ziploc baggie and throw it in the freezer. And then when you graduate, you thaw it out and then deal with it. But ignoring your mail while you're in school can cause you to miss out on important information, such as your loans just went into default because you failed to file a required form. If you deal with it more quickly, it'll be less of a hassle to fix. And I try to start off organized and stay organized with regard to your student loans, and have file folders for each loan, have a cover sheet where you list all your loans and all the important information, and especially the deadlines. Now, you may hear from organizations that claim to be able to save you money. You just have to pay them something. These are called advance fee loan scams. If you have to pay money to get money, it's probably a scam. There are federal and state laws that prohibit charging a fee for credit repair before that work is complete. Now, reducing student loan payments, getting a deferment or forbearance, switching repayment plans, and applying for loan forgiveness, they're all considered to be credit repair. So if an outfit contacts you saying they'll do the work on your behalf, all you need to do is pay them a fee, and beware. Because not only do some of these, and it's charging for something that's very easy to do on your own. It takes less than half an hour at studentaid.gov to do this. But some of them go beyond that, and you're paying payments to them thinking that it's going to your loan, when in fact they're just keeping the money. Now, the Federal Trade Commission and the state attorney generals have led a crackdown on advance fee loan scams called Operation Game of Loans. And they've been shutting down a lot of these, but for every one they shut down, another one pops up somewhere. So you need to be aware that someone's charging you a fee up front, don't pay it. And never share your FSA ID. That's the identification, the username and password that are used to file the FAFSA and deal with your student loans online. It's like giving your signature to someone. It's an electronic signature, and they can do things like change where your loan statements go, and other things that borrow new loans in your name, which you really don't want to let them do. Now, on our site, we've added a lot of new tools. We have regular student loan calculators. This is showing a screen snapshot of a prepayment calculator where you say the loan amount here is $30,000, what the interest rate and what your current monthly payment is. And you can tell them, I want to pay an extra $50, $100 a month. What does that do to my paying off my debt and the total amount I owe? Or if you want to pay off by a certain number of years, it can do that calculation as well. And then here's a screen snapshot of the savings from refinancing. Same deal, a $30,000 loan, but instead maybe you're making, you have a lower interest rate. And this example is 4% versus with a 7-year repayment term, shows you how your monthly payment changes and how your total payments change, and so therefore how much you save. So I have been running a little bit long, but we still have time to answer a few questions. And by the way, we have this new portal on our website, savingforcollege.com/student-loans, where you can get access to our loan calculators, all our articles, and our student loan rating systems, and it's all free.
Awesome. Thanks a lot, Mark. And just to echo what he said there, I'm sending in the chat window right now the link to that portal. So again, savingforcollege.com/student-loans. So going on to the questions we have so far, one of the first we had was, Mark, can you touch on 529 plan So for owners who deferred using it while their child was in school to allow the plan to grow 2 to 4 additional years and are now looking to pay back student loans as well as Parent Plus loans with that 529 plan.
Now, this question comes up a lot, especially during the pandemic, where from February to March, the S&P 500 went down by about a third. And so people don't want to be in a hurry to take money out of their 529 plans in order to let it recover before they use it to pay for college. The Secure Act, which was enacted last year, allows you to take a qualified distribution from your 529 plan to repay up to $10,000 in student loans, and $10,000 for the beneficiary and $10,000 each for siblings. It's a lifetime limit, so even if you have multiple 529 plans or your siblings also have 529 plans, the combination can be no more than $10,000. But this gives you more flexibility. So maybe you borrowed during the freshman year while waiting for the pandemic to disappear, or certainly the economic downturn to recover. You can now pay back those some of your student loans. And it's available for both federal and private student loans. Technically, it's qualified education loans, which includes all federal loans and most private student loans. But it's a good benefit.
Nice. And then another question here. Could Mark touch on the mindset of some students who just say, I'll only pay the minimum for a long time and then eventually get the loan forgiven?
Well, and some students are hoping that the next president or Congress will wipe out all student loan debt, but it's probably not going to happen. It's like waiting for Godot. You wait and wait and wait, and it never happens. And in the meantime, your loan gets larger and larger and larger. The problem is, and consider that, let's suppose Joe Biden gets elected and he's proposed some form of loan forgiveness. It's if you're at a public college, graduated from a public college, and it's tuition related debt, which isn't clear what that exactly that means. But there's also in the HEROES Act a proposal to forgive $10,000 of student loan debt, and other people are urging Congress to forgive $30,000 student loan debt. But consider that of the 25 candidates for president on the Democratic side, only 4 of them, now Biden makes a 5th, had proposed any kind of widespread loan forgiveness. The others proposed more targeted loan forgiveness, like for teachers or something like that. So the next president, if they propose something like this, they're not only going to have to convince the Republicans, but they're also going to have to convince the Democrats. And there are a lot of proposals that the various candidates have made, including Joe Biden, and this may not be their top 10 in their top 10 list. This may be lower priority. So they may have other things that they are focused on, like getting rid of the pandemic and curing COVID-19, getting vaccines out. So I don't think it's very likely to occur. But people do switch to having a lower payment to put more money in their in their cash flow, especially if their jobs are more limited. Maybe they lost a job and so they need to conserve as much cash as possible. But it's also sometimes they want to spend their money now and they're not thinking about their future self, where their future self is going to have to pay for having that lower monthly payment and therefore more interest paid over the life of the loan.
Right. And then we'll see if we can get 2 questions. Somebody asked, they're a recent grad student and they're still job hunting. You mentioned that the payment of student loans were extended, the payment pause was extended through September 30th, 2020. They're asking if they're looking for employment now, they're not employed by September 30th, 2020, should they consider deferment or forbearance?
Okay, so first of all, the HEROES Act proposed extending it by a year to 2021 and also expanding it to all federal loans and some private loans. So that may happen. And the loan forgiveness that's in the HEROES Act is opposed by the Republicans, but some of the Republicans have expressed some support for extending the payment pause and interest waiver for a year. Well, let's suppose that it isn't. What are your options? For the federal loans, there are the deferments and forbearances. In particular, there's an economic hardship deferment and an unemployment deferment that may apply. There's also the income-driven repayment plans. If your income is less than 150% of the poverty line, the income-driven repayment plans, except for income contingent repayment, will yield a 0 monthly payment. So that's another way of getting financial relief. Um, the and if you happen to be pursuing a public service job, if you're working full-time in a public service job, the current payment pause and interest waiver counts towards that loan forgiveness. Now with private loans, there are basically the forbearances and partial forbearances that are the main options, but you should also call the lender or email the lender and ask about your options, because some of them are providing some flexibility. Like with private student loans right now are offering a COVID-19 forbearance, which is a 90-day suspension of the repayment obligation. It doesn't count against the 1-year limit on forbearances. And call them up at the end of that COVID-19 forbearance, they might extend it. And explain your situation, ask them what options are available to you. Before you call them, check out their website to see what they say their options are, so that if they don't offer you one of those options, you say, well, what about that other option?
Gotcha. And yeah, we're right basically on time. So before we sign off, just wanted to say we launched a poll. So if you guys, before signing off, you could fill out that poll real quick just to see how we did. That would help us for future webinars. Secondly, also want to promote the next webinar we're going to be having that's actually about challenges during repayment. So if you guys have challenges during repayment, are trying to overcome those challenges during repayment, please do sign on to that webinar. I'm going to send an email about that afterward, but I'll include the link right here in the chat window. And beyond that, Mark, any final thoughts for the audience?
Well, all the questions that have been submitted, I will be reviewing them and answering them if they're not already answered on our website. It takes me time to write all those answers. I'm just now finishing up the answers from a webinar from 3 webinars ago. That one was about college savings. I ended up writing over 14,000 words in responses to those questions, and we'll be putting out those articles over the next few days. So if your question didn't get answered right now, it will get answered within the next few weeks.
Yep, and just one other thing about that webinar next week, it's going to be on Wednesday at 1 p.m. Eastern time. So July 22nd, 1 p.m. Eastern time, and it's going to be a new webinar, so it's not going to be a repeat one. So the new topics there. Anyway, we'll hope to see you guys next week. Thanks a lot, Mark, for joining us, and all of you have a good Thursday.